It is the 24th of April 2021. My name is David Hickson, and in today's market update I'm going to be talking about Hurst cycle targets, how they can be interpreted, understood and applied. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. So here is a chart of the S&P 500. This is the analysis that I've been speaking about over this sequence of market update videos. So we've been tracking it fairly thoroughly. There's not much to say about it. Of course, we have the big trough in March of 2020, 54-month cycle trough, or possibly even a longer cycle trough that formed then. The 40-week cycle trough, which formed at the end of October last year, and then the 20-week cycle trough, which according to this analysis formed at the beginning of March this year. There is some possibility that that 20-week cycle trough actually occurred a little earlier in February, but we're not going to be speaking about that in this video. What I wanted to speak about in today's video was the concept of the Hurst cycle targets. Let me zoom in here and take a look at the price action that has happened this week. And if you take a look at last week's video, you will know that I spoke about the pattern that was forming because of these multiple FLDs. And price, of course, started entering into this pattern. In other words, it sort of crossed down below the 5-day and the 10-day FLD. But then something really interesting happened. Now, the first FLD that price encountered was, of course, the 5-day FLD, which is this very pale line over here. And on Monday, the median price of that bar crossed below the 5-day FLD. Why do I speak about the median price? Well, because the FLD is based on the median price, which is the mid price between the high and low of each bar. And because it is based upon the median price, we are looking for interactions between the median price and the FLD as having some meaning. And so let's actually display this chart as a median price chart. There is the median line, and you can see there is the point at which the median price crossed below the 5-day FLD. Now, at that point, we can generate a target. So if we switch back to the candlestick bar, we calculate the target by being the distance from the previous high to the point at which the median price crossed the FLD, which was that level over there. And as a result, we generate a target. Let me zoom in even more so that we can see this in greater detail. So the target for price crossing this 5-day FLD, that's the cross level over there, was at a level of 41.50. There it is over there. So 41.50 was our target, and as you can see, price came down and met that target at pretty much the low of the day on Monday. Now, when I spoke about the cascade pattern that was forming, I explained that in a true cascade pattern, what should happen is that the target for each FLD as price crosses it extends beyond the next FLD. In fact, that target level on Monday was not below the level of the 10-day FLD. Let me highlight that 10-day FLD. So you can see how that target on Monday was not actually below the 10-day FLD. And so it was not projecting beyond the next FLD, which meant it wasn't a true cascade pattern. However, the very next day, on Tuesday, the FLD had jumped all the way up to this level over here at about 41.80 or 41.78. And so by price not really doing anything, it ended up crossing below that FLD. And so when price came back down to that level on the next day, on Tuesday, it did effectively project a level beyond or below the 10-day FLD. And so price did also cross below the 10-day FLD. Let's work out where it did that. And again, we will display the median price to understand exactly where the median price crossed below the FLD. Let's rub out some of these lines here. And there is the level at which median price crossed the 10-day FLD. And so if we display our candlesticks again, we can calculate our target for the fact that price crossed below the 10-day FLD, and that target was at a level of 41.28. So there is the level of 41.28, just a little bit below the close, but a little bit above, as I think you can see, the level of the 20-day FLD. And so again, we didn't have a true cascade pattern, because the level of that target, and let me draw it as a line that extends further, because the important thing is that those targets don't change. Once price has crossed below the FLD, it has generated a target. The only way in which that target would change is if the price cross itself became complex. In other words, price crossed then back above the FLD and then below it and then above it and then below it again, and that results in what we call a complex price cross, and calculating that target becomes a little bit more complicated. But that is not what happened in the case of the 10-day FLD. And so price achieved the target of having crossed below the 10-day FLD, but it did not project below the 20-day FLD. And at that point, as I explained in last week's video, the cascade pattern itself doesn't project any further downward movement. At what point did price cross the 20-day FLD? Well, again, we must go back to our line on median chart. And here you can see an interesting thing. The median price never actually crossed the 20-day FLD. And so we do not yet have a projection down as a result of price crossing that 20-day FLD. Is it still possible that price is going to come down and cross below the 20-day FLD? Yes, it is still possible. And in fact, we are expecting price to cross down below the 20-day FLD at this point, but it doesn't absolutely have to. One other thing to point out here while we're discussing price touching the 20-day FLD, we have a system that sends out tweet alerts on Twitter. So if you're not following us on Twitter, I'd encourage you to do so. Here is the tweet that went out on Tuesday, and here is the chart, as you can see, and there is price coming down and touching that 20-day FLD. An important point to make here is that often when these tweets go out, we get comments on the tweet asking what it means. And in fact, when price touches an FLD, we have an expectation. And in this case, the expectation is that price is going to cross down below the FLD on its way down to this 80-day cycle trough over here. But the point at which price touches the FLD is not the time at which we need to do anything. It's the time to sit up and take notice, because price has touched the FLD and now we need to watch it. And that's why we send out those tweets when price does that. The meaning is not yet clear, but it provides us with an alert, if you like, to sit up and take notice that something is happening. Now, the next thing to notice in this analysis, which is slightly different to the analysis that I've been looking at, is that we still have the 20-week cycle trough here at the beginning of March. But an interesting thing has been happening with these nests of lows. You can see that the 40-day cycle trough has not yet been positioned in this analysis. And here is the 40-day cycle nest of lows leaning over to the left. Of course, in the chart that I've been looking at, I have positioned the 40-day cycle trough at a very early point over here, which is slightly questionable. But in this analysis, that 40-day cycle trough has not been positioned, and so it is still not found in the analysis. And as a result, you get this sort of splayed effect with the nests of lows. You have the 40-day cycle trough nest of low leaning over to the left over here, and you have the 80-day cycle trough nest of lows leaning over to the right over here, with a big sort of gap in the middle, and we are right in the middle of that at the moment. It's an interesting situation that sometimes develops in the markets, and it's happening at the moment because of our inability to position the 40-day cycle trough with any absolute confidence. Which brings me to the subject of confidence in an analysis, and let's switch back to our analysis and zoom back out again. As I think you can see, I've zoomed out a little bit quickly, but the 40-day cycle trough is in fact positioned in this analysis over here towards the end of March. But in terms of the question of confidence, what is my confidence in this analysis? Well, I'm not entirely confident in the position of the 20-week cycle trough. And in fact, you can see in the analysis that Sentient Trader has plotted on the chart, these diamonds are hollow. That means that they are not entirely confirmed, or perhaps our level of confidence in the analysis, sentient traders' level of confidence in the analysis, does not extend down to this 20-week cycle trough. The most recent trough that has been positioned with some confidence is this solid trough over here for the 40-week cycle. And so the level of confidence that Sentient Trader has in this analysis, and me too, is at the level of the 40-week cycle. And so if I zoom in again, let's consider what is happening here. In this analysis, we have a 40-day cycle trough positioned over here in the third week of March. As I've mentioned, I'm not very confident about that, but it's difficult to find another position for the 40-day cycle, which is fairly clear because of the very straight upwards movement that we have had happen since the third week of March. And so where else would you position that 40-day cycle? That is why I leave the 40-day cycle over here at the foot of the chart, which means that, of course, the next big cycle trough that we're expecting to form the market is this 80-day cycle trough. Now there is the circle for the 80-day cycle right about the beginning of May, but here is the nest of lows, and you can see it's a slightly staggered nest of lows. This analysis differs from the analysis I showed you in that tweet, and we have a clearer nest of lows, and it does raise the possibility that an 80-day cycle trough has formed over here, which is right above that nest of lows. Has the 80-day cycle trough formed? In my opinion, it hasn't yet, because as you can see, only 47 bars elapsed. It was a bit difficult with that arrow there, so let me get rid of that arrow. Only 47 days elapsed from the 20-week cycle trough, the beginning of March, to the low price on Tuesday. And 47 is really very short for an 80-day cycle, the average length of which is 68 days. And if you don't understand why the average length of an 80-day cycle is 68 days, I would encourage you to download the 10 core concepts of Hurst cycles, which I will provide a link to in the description below this video. And so that would be a very early 80-day cycle trough. It is certainly possible. However, it is also possible that price is going to turn around and continue downwards and achieve an 80-day cycle trough a little bit later. When there is some uncertainty in the analysis, it's often very useful to take a look at other markets and other stock markets around the world. Let's take a look at the FTSE 100 from the UK. There are some important differences in terms of this analysis. Here we have a 20-week cycle trough, which is positioned not in the first week of March, but in the last week of February. That means the number of days until the low price on Tuesday was 54. Now 54 is quite a lot closer to 68, and if you take a look at the nest of lows at the foot of this chart, you can see there is the nest of lows for the 80-day cycle, and so this becomes a very possible candidate for the 80-day cycle. And that 40-day cycle seems a much more reasonable position. It wasn't really a very early 40-day cycle. If we measure the number of days, you can see there were 28 days, so not nearly as early as the 21-day cycle wavelength that we have on the S&P 500 chart. And so bearing in mind that other stock markets around the world might well have formed their 80-day cycle trough last week, we need to bear that in mind when considering the S&P 500 and other US markets. There was another point that I wanted to make about targets, and let me zoom out again. We had an interesting question in response to one of the tweets that went out this week about the Hurst cycle targets. And the question was whether, seeing as price had now touched another FLD, I think it was the 20-day FLD, whether that changed the earlier targets that had been calculated. As I mentioned earlier, it doesn't. When a target is calculated, it is a fixed target. But there's an interesting thing when it comes to Hurst cycles targets, which I thought would be worth mentioning. And that is that whereas in some approaches, when you generate a target, you absolutely expect that target to be achieved. And if it isn't achieved or reached, then there's some kind of a mistake. And the other thing about targets in other approaches is that when that target is reached, the market is expected to turn around. That is not necessarily the case with the Hurst cycles target. Hurst cycles targets, whether they are generated as a result of price crossing an FLD or using the Zig-Zag feature that I demonstrated several weeks ago, A target simply represents a level at which the cycle momentum, if you like, will have been achieved. And I would like to demonstrate something about the zigzags, which, as I mentioned, I discussed a few weeks ago. I discussed the 18-month zigzag, and I believe that the target at that time, you could go back and look at the video, but I think it was close to 4,400. That was the upside target for the 18-month zigzag. Now, an interesting thing has happened with the zigzag, as you can see. It's no longer projecting upwards, it's now projecting downwards. Why is that? That's because the zigzag tool in Sentient Trader considers that the recent price highs potentially represent a fulfillment of that target. However, the price level has not yet been reached. And so why has the zigzag tool already turned down? Because that target has not been reached. And the answer to that explains the way that we approach targets with Hurst cycles. And that is that if a target is exceeded, then that represents an excessive amount of bullishness, or not excessive, an extra amount of bullishness, if you like, in the market. On the other hand, of course, if a target is overshot to the downside, then that indicates an additional amount of bearish pressure in the market. Similarly, if a target is not reached, that does not indicate a failure of the cycle model or of the analysis. It simply indicates that there is an additional amount of bearishness in the market which has resulted in that target not being achieved. And potentially that is the case at the moment. If indeed this does turn out to be the peak, then the fact that it did not reach that target simply indicates that there has been a slightly increased bearish pressure compared to the point at which this target was calculated during this period of time here when the price action was moving downwards. And it is not a big surprise that we have additional bearishness in the market, considering the fact that the 18-month cycle itself should have turned down and should be influencing price to move down towards that 18-month cycle trough. As a matter of interest, while I'm displaying this zigzag, why is this circle so big? It's a fairly useless target. Well, that's because it has not yet been able to generate the target. This is the initial state of a zigzag. We don't have an actual zigzag yet. As price action unfolds, the zigzag itself will develop and we will refine the placement of that target and end up with a tighter circle over there. But of course the zigzag tool made the assumption that that peak has formed, and it might not have formed. As I've been discussing over several weeks, the process of forming a peak is fairly complex, and we might still see higher prices before price turns down and comes into this 18-month cycle trough. Let me quickly display the Composite Model Line, which is, as you know, another way of visualizing the implications of an analysis. The Composite Model Line takes all of the cycle information in the analysis at the foot of the chart, and it combines it and presents it in the past, indicating what would have happened if the only thing influencing price action in the past had been the cycles that have been found in the market or in the analysis. It then projects that information forwards. And as you can see, and as I've mentioned in several of my videos recently, the move down into the 18-month cycle trough is not expected to be a very dramatic affair. Here is the 18-month cycle trough according to the Composite Model Line, and the move down into it is not very great at all. However, it is very important to remember the Composite Model Line is simply another way of visualizing the analysis at the foot of the chart and using the cycle information that it is found there. There has not been a great deal of downward cycle movement, which is why the downward cycle movement in the Composite Model Line is not very evident. As price action unfolds with each new day of data, the Composite Model Line will be adjusted, as indeed the analysis is also adjusted. But with the analysis information that we have available to us in this analysis, at the foot of this chart, that is the expectation on the basis of the Composite Model Line. I do hope that you found this market update interesting and useful. If you have any questions, please put them in the comments below this video. I look forward to hearing from you.